We've got a tale of two economies. Let's talk about it on Today in Mortgages. Hey, what's up, Dreammakers? Welcome back to the show. We're talking about what's real, what's hype, and what we should actually be paying attention to out there in the world of mortgages and real estate news. It is Today in Mortgage, and I've got my favorite expert back with me here today, Rich Jefferson. Rich, how you doing?
Good morning, Michael. Let's
Hey,
get after it.
let's do it. Rich, we're going to look at an article today just as kind of a touch point on what happened with inflation data last week. It is from Business Insider, and the title says, "Cooling inflation data means the Fed is in a position to cut rate in June, chief economists say." So, Rich, first of all, based on that title, there's a prediction in that. What are our thoughts on this?
It's funny. I mean, you listen to some, and yeah, we're still going to see rate cuts in June. And now, yesterday, I think the percentages dropped down to less than 50% that we're going to see a rate cut in June.
So,
But
yeah, it's different based on who you talk to,
yeah,
and the stats that you're looking at. But real quick, what happened with the report last week?
well, it came in, pretty much as expected, which is good news because we were expecting some slowing inflation, and that's kind of what happened. But it's just, again, it's what are your expectations? If your expectation is just built around, is the Fed going to reduce the Fed funds rate, then some of this news may not feel good. But if your expectation is we want to see slowing inflation over time while still keeping a strong economy, then maybe that wasn't good news for you, because now they're talking about maybe we won't see a Fed fund rate. Some are saying we may not see one this year. When I say some, I mean some Fed members are out talking about this. So who knows?
And if you're in the media and you're looking at this, there's two ways to read it. And that's what we're seeing in different articles that have come out, different headlines that you see. And that's why we want to talk about it today, because it might be confusing. But those two ways are that, Rich, we had month over month increase by 0.3%, which it's just a little higher than it needs to be for that 2% average that we want to see long term. But the year over year was 2.8, which was down last month from 2.9. And so, yes, it's down, but month over month, it's still too high. It's just like this balancing act of, hey, are we seeing this consistent data that the Fed's asking for? So I don't know the answer to that. Rich, what do you think?
I think the Fed is seeing what they expect to see. It's hard to control inflation while still keeping your economy humming. There's still a lot of discretionary income out there that, although it's moderated a bit, not everybody is spending all their savings anymore. That's slowing things down over time, but the economy is still remaining very strong. Look at the unemployment numbers. There's still lots of open jobs. So these are all signs of a good economy, and we're just not going to see the expectation of the Fed fund rate come down as quickly as we had hoped, because it's still hot. The economy is still pretty hot.
And that's why we said at the top of the episode, tale of two economies, right? We have really good indicators on one side that are unfortunately keeping inflation a little high, but it's good for the economy in general. But that high inflation is bad for rates, which is tough for our industry. So, it really is a tough thing to grapple with. We've been wanting to see those rates come down for a long time. We're just not sure when it's going to happen. But Rich, the good news that we've been talking about on these episodes is that, like I said, the economy is strong. There are people wanting to get into homes. People are coming to grips with this new reality of rates, and everything's kind of trending up in the industry right now. It's not explosive growth, but there is growth, and we're excited about that. And so, Rich, when we talk to our people about what they should be concentrating on right now, we're telling them not to concentrate on rates, right? What are we telling them to concentrate?
Right. Yeah. I mean, be aware of where rates are, just so that you can explain it to your borrower should you get questioned. But really, it's about what is the budget of the home buyer? Just sell payments. What's comfortable for them? The rate ends up being, yes, of course, it's important in the process. But if you build it by payment and they're comfortable with the payment, then the rate is just the rate, and it's a temporary rate. So I don't know how temporary, but it's likely going to be refied. So, get them in the house right now, because you'd rather get in the house at the price today, at the rate today, than at just a scotch lower rate and a much higher price later, because prices continue to rise in housing.
So bottom line is, if you're selling on rate, you are fighting a losing battle. So we need to be selling on value and the future that you are providing for this family, this buyer, and the home that they really want to be in. And so that's what we're talking to our people about. That's what we want to be talking to you about. And that's what you should be concentrating on. If you're interested in learning more about this and the tips and tricks that we're bringing to our people inside the network and how you can be a part of that network, click on the Grow link below and we'll talk to you all about that. Rich, before we got on the call, you said this looks like we're almost having the same conversation that we had 4 months ago, but we're in a different situation now than we were 4 months ago, just in kind of our market, right?
Sure. Yeah. I mean, you look throughout our industry and, the green shoots that we've been talking about are starting to show themselves. We're busier than ever. Heck, we're hiring again. So just goes to show you this business is so cyclical. And here we are, ramping up again because things are starting to improve for us. So, all I would encourage people to do is take a look at network funding. Call me. Let me tell you about our story and why I'm so proud about the company and what we do on a daily basis for our employees and for our borrowers. Reach out. I would love to share the story. And if anything, you just learned something new about network funding.
Good word, Rich. And like you said, it might have been a little bit of Groundhog Day on kind of the indicators that we're looking at. But the good thing is that we are in a different climate as far as borrower and buyer sentiment. And so things are looking up. We're excited, and we are excited to continue to bring you coverage of what is important and what you should be paying attention to out there in the world of mortgage and real estate. So thank you so much for joining us today, Rich. Thank you to everyone out there for watching and listening wherever you are. We appreciate you, and we'll see you next time on Today in Mortgages. Today in Mortgages is produced by Network Funding LP, which is an equal housing lender, NMLS 2297. The content of this program is meant to be a commentary on mortgage and real estate news, and any discussion of rates and or products should not be taken as an individual mortgage or home buying advice or pricing estimates. And any commentary on this show should not be considered a promise to make a loan. All applicants for a loan must qualify, and you should consult a professional regarding your individual loan scenarios for your financial situation. Visit our website at nflp.com/licenses for all state licensing and other legal information.